So today's webinar is entitled Europe and the Great Lockdown, Economic Outlook and Policy Priorities to Reopen the EU Economy. This event is organized by the European American Chamber of Commerce and our network of chapters across the United States and Europe. We are where Europeans and Americans connect to do business. This event is funded by the European Union and is organized in alliance with the Business Council for International Understanding and the State International Development Organization. I'm Todd Schwartz, Executive Director of the Cincinnati chapter of the EACC, and I'll be your host today. And we have nearly 300, I believe actually over 300 registrants for today's event from Belgium, Canada, the Dominican Republic, France, Germany, India, Ireland, Luxembourg, Mexico, the Netherlands, Romania, Slovakia, Spain, Sweden, the UK, and the United States. So I'm sure we'll have a vibrant transatlantic and international discussion. One quick disclaimer, please note that all comments and opinions presented by our speakers today are their own and do not necessarily represent the views of the European American Chamber of Commerce or its members. You will have seen their biographies when you registered, so let me just quickly introduce our presenters today. Christian Orsini is the Counselor for Economic and Financial Affairs, and Ben Carliner is a senior economist both at the EU delegation to the United States in Washington, D.C., and Dimitrios Ratsikis is a senior economist with the European Central Bank representation to the International Monetary Fund, also in Washington, D.C. Moderating today's discussion will be my colleague, Yvonne Bendinger-Rothschild, Executive Director of the New York chapter of the European American Chamber of Commerce. Yvonne, over to you. Your microphone is muted.
Thank you, Todd, and good afternoon, everyone, and thank you for joining our discussion about the economic outlook on Europe. I also like to send a quick thanks to BCIU and CEDAW who helped us promote this program today, and of course, Chris, Ben, and Dimitri for sharing their expertise with us. The COVID-19 pandemic is probably the biggest shock to the global economy since the financial crisis in 2008. Governments worldwide took unprecedented steps to combat not only the virus, but also protect their citizens and businesses, while the economic activity froze to pretty much zero activity. Today we will examine how the crisis compares to previous downturns, the economic consequences of this crisis, and how effective or challenging the EU policy response has been in past and present, and how that will these measures that were taken will boost resilience and restart the economy as we start opening again and re-emerge from hopefully post-COVID-19 very soon. To dive into the issues, I will hand the floor to Ben, who will start us off with a discussion. Ben?
Okay, thank you very much, Yvonne. I'm very happy to be here today and welcome to all of you. I'm going to start off with a discussion of how we came up with this forecast and some of the basic things that we know about what the economy has been going through up to this point. And I'm also going to give you a bunch of caveats because we are really in uncharted territory with this forecast. Even in the best of times, economic forecasting can be a little bit tricky, but in this situation that we're in now, it's especially difficult. This is really unprecedented, the type of crisis we're living in right now. And this has forced the forecasters at the European Commission to be particularly creative in terms of figuring out how to come up with the numbers that we're going to present here today. One thing I'd like to say is that, this should be obvious, but this is not like other types of recessions where the normal types of policy levers that you would pull, the need to correct imbalances or to, deleverage your economy, that's not what we're talking about here. We are talking about a situation where the economy all over the world has been put into lockdown to halt the spread of the pandemic. And this requires looking at new data and, adjusting the way that we build the forecast from the ground up. So some people have tried to make comparisons to a pandemic being sort of like a natural disaster. And it's sort of like a natural disaster, but it's also very different than a typical earthquake or something like that. You have not had the destruction of physical plants that require, that allow the economy to bounce back rapidly afterwards because you have to reconstruct buildings and things like that. That doesn't exist. And on the other hand, you also have the potential for longer term changes to consumer behavior because of the fear of getting infected and because people might change the way that they go about some of their normal working and socializing activities. But, we have not been able to put off doing a forecast in this sort of circumstance because policymakers need to have some sort of idea of what's happening and where we're going in order to pull the right levers and to do the right things. So the Commission has come up with this forecast. It's a bit sobering in terms of the numbers. We all wish that it wasn't such a severe recession, but this is where we are. But let me give you a couple of caveats. One of the things is that the economists at the Commission have been looking at a much broader array of data, and they've been putting it together in a different way from previous forecasts. So we've been doing much more model-based scenarios in terms of making some assumptions about how things are going to play out and looking at different scenarios there. We've also been looking at different indicators. And of course, all of this is informed by trying to find examples of previous pandemics and other things that we can use to get a handle on what's happening and where we're going. Let me tell you a little bit about the key assumptions, because those are very important. The assumptions are that the containment measures will be gradually lifted starting around now, and that once those happens, we're not going to see a huge reemergence of second or third waves of this pandemic, that it's going to work and people are going to get better. Finally, we're also assuming that the policy measures that have been put in place are going to help cushion the immediate economic impact and limit the permanent damage from the pandemic, from permanently damaging potential output and things like that. So with that, let's move on a little bit, tell you what we know at this point. So what we know is that the pandemic started in China, obviously, and only then did it spread around the world. And I want to talk a little bit about the channels through which the economic impact has spread around the globe. First, in China, as the COVID-19 started to spread in Wuhan and to other cities, Chinese factories and cities went into lockdown. Now, the first way that this affected the global economy was through global supply chains, particularly because we have all this, global supply chains stretching around the globe with just-in-time delivery. If you have, certain supplies, certain widgets coming from Chinese factories, even if you're assembling a car in Germany, if you don't have that one piece, the whole manufacturing process can come to a stop. And so this was the first way that the rest of the world felt this, was that Chinese factories shut down, they stopped exporting things, firms started to run out of the supplies they needed. The second channel was that Chinese consumers stopped going shopping. And Chinese consumers are major purchasers of European goods. And so demand for European exports in China and services, goods and services, went down a lot. Now, as the pandemic began to spread outside of China, the first thing that happened was it affected other countries in East Asia that are also parts of the global supply chain and also big purchasers of European goods and services. And so this was a further blow. But the real impact, in Europe anyway, happened when the virus had spread to Europe and when Europe itself started putting containment measures in place. So you can see on the chart on the right here that these are PMIs. And so these are important indicators. They're survey data of what purchasing managers are seeing in terms of future of their output of their factories and their offices, and also things like the new orders that are coming in. And you can see that on the right, particularly the PMIs for services and constructions just collapsed once the COVID had spread to Europe and the containment measures were put in place. this was, really quite severe, and really got people to thinking, boy, this is a problem. This is going to be a big challenge. But at that point, the PMIs sort of ceased to be as useful as they, you needed to look for other types of economic data to figure out what was going on, because that's just survey data. And you couldn't wait around for GDP figures and for unemployment figures, because those are published with a lag. And so once they're published, you use them. But in the meantime, you need to look other places for data. And so these charts show you things like the demand for electricity, air traffic, daily truck mileage. And what these show you is that, first of all, Italy was the country affected, was the first country to be affected in Europe. They're the gray line in those charts. And you can just see how electricity demand started to plummet in Italy as they shut down factories in the north. And that was soon followed, and also the transportation sector was shut down as Italy imposed controls on travel. But these soon spread across Europe, and within a week or two of happening in Europe, other European countries faced the same sort of issues that Italy did in terms of implementing these containment measures and in terms of economic activity just shutting down. So initially, it was a lot of, transportation, trade stuff that went down, but it soon spread. And these are some of the key things that people were looking at. So at this point, once people are locked in their houses, the lucky ones working from home, the other ones being forced to, apply for unemployment benefits or engaging in short work schemes, then people started to try to figure out really what we were facing and what to do about it. And it was a big shock. I think we were all taken quite by surprise with this. Now, uncertainty about where we're going is huge. And so, I want to give you the caveat that all the numbers in this forecast and all the things that we're going to talk about are subject to really, really large measures of uncertainty. But I want to talk a little bit more about what some of the specific factors that we are uncertain about are and dig into them a little bit. If you remember, only a year ago, a lot of people were worried about protectionism and U.S. trade policy in particular, because the U.S.-China trade conflicts were very disruptive to the global economy. They were hurting business investment. People weren't sure how that's going to play out. And now we have uncertainty about how this pandemic is going to change the economy and whether it's going to change it permanently. So first, I'd like to talk a little bit about the labor supply disruptions. Labor supplies have obviously been disrupted primarily because of these containment measures. People can't go into the office. People can't go into factories. Obviously, some essential businesses are still open, but other people have been sick and they can't get to work, or they have to take care of relatives. Now, a key question is whether these job losses are going to be temporary or whether they're going to become permanent job losses once the economy reopens. Now, in this regard, you can look to the impact on different sectors, because not all sectors are affected by this in the same way. Obviously, some of the most effective sectors have been travel and tourism, restaurants and bars, big sporting events and business conferences and things like that. If you need to have social distancing measures and people don't feel safe, those businesses and those sectors could be facing long-term challenges to their business models. On the other hand, if you want to look at the manufacturing sector, those interruptions to the labor market are much more likely to be temporary, because once you can reopen factories, then supply chains get going again, factories reopen, and you can start producing again. Now, there are going to be longer-term questions about whether supply chains get reformed in order to have a little more redundancy built into the system, but nonetheless, it's important to look at the different sectors and see how they're going to be affected unevenly. Now, on top of this, you have things like school closures and the inavailability of childcare. that also affects people's ability to work. And depending on how some of the social distancing measures need to be kept in place for a long period of time, that also could become significant. Now, on top of this, you have to think about some of the uncertainty surrounding income losses and what this is going to do to demand. Because while, you know, a lot of jobs have been, particularly in Europe, saved by short work schemes, and, you know, workers have been supported by being able to access unemployment benefits. If people suffer permanent income losses, they're going to buy less in the future. And if they're worried about the future and the safety of their job and what might happen, they're likely to save more. And so all these things would mean that there's less demand in the future, and that when the recovery does come, you have to gauge, is it going to be just as much as we're hoping that there's going to be this big bounce back, or is higher precautionary savings going to lower demand for a longer period of time? Finally, and just briefly, in the initial phase of the onset of this pandemic, there was a big liquidity shock and financial market disruptions. These have largely been dealt with because of the ECB's extraordinary actions that Dimi is going to talk about later. But there is a concern that in the meantime, that a lot of companies, a lot of businesses, a lot of individuals are going to take on more debt, and that could weigh on growth in the future. It could become an issue. And this is something that is also going to be different depending on different countries, different sectors. It's going to be very heterogeneous how this plays out. So those are some of the major uncertainties and how we've been thinking about them. Let's move on now.
Ben, if I may chime in for a second. You're talking about the uncertainty in your projections. What I was thinking is, since this crisis is rolling out from east to west, is there some benefit that we can take, some perfect vision that we can benefit from looking at, not only the measures that are taken, but also maybe extrapolate that to the recovery, especially on the US side? Can we learn from what is the measures that are being taken in Europe and, apply them in the US, or other economies just too different and the impact too difficult to compare and plan out?
No, thank you. That's an interesting point. I think, I'm an economist. I don't know much about public health, but I think that in the public health arena, I think both the US and Europe could learn something maybe from some of the countries in East Asia. I'm thinking of Taiwan and South Korea, who had experience with the SARS epidemic. And I think both of our continents could learn something from how they've dealt with the public health issues there. But in terms of the economy, I think one of the key takeaways for the United States is that the social safety net in the United States doesn't work that well. And if you look at the rate of that unemployment has shot up in the United States much faster and much further than in Europe, I think this points to the fact that many of the institutions that underpin the social welfare system in Europe just simply work better. And that is something that I think the United States could benefit from, looking at the European experience and making sure that the most vulnerable members of society are protected in an environment like this. So let's quickly move on because I'm running out of time. But the next slide here. So what do we know at this point? We've shown you some of the very quick indicators. We've talked a little bit about uncertainty. But let's talk about how bad this global recession is going to be. We know that this is the worst and deepest and broadest global recession since the Great Depression. The numbers have been really, really bad. There has been just a collapse in the first quarter and second quarter numbers. So what we are thinking is happening is that everything, global output, trade, employment, it has been contracting. First, it started in China and in East Asia, where the Q1 numbers are probably going to be worse. But as it spread to Europe and the rest of the world, including the US and other emerging markets, the second quarter is likely to be the worst quarter in terms of performance. And we're hoping that there will be this rebound, but it's not just the pandemic that is a big shock and the containment measures that are a big shock to the economy right now. We also have this oil shock where the price of oil has really collapsed, both because demand for oil and other energy has fallen by a quarter to a third since the containment measures have been put in place. But on top of that, there's been this oil price war that the Saudis have launched, and they have not agreed to, OPEC Plus members have not agreed to cut production enough to meet the fall in demand. And so this has meant a huge fall in oil prices. And this is a significant hurdle for a lot of emerging market oil exporters who are not going to be earning the money from their oil exports that they were expecting. This is going to cause them to have to do some fiscal tightening, and demand from these countries is going to go down a lot. So just in terms of global demand, this is set to continue, and partly because of the containment measures, but partly because of oil as well. And so this is going to be something that really drags on the recovery, because it's the whole global economy, and in particularly for small open economies like we have in many European countries, they really depend on global demand for a lot of their goods. So we've got this triple shock of a global pandemic, collapsing oil prices, and some ongoing financial market turmoil that, even though there's not so much turmoil in the US and EU right now, there still is some turmoil in emerging markets, and that could come back. So just to give you some numbers, there's going to be a very deep recession. The forecast numbers from the European Commission show that global GDP is going to contract by around 3% this year. And as bad as that is, that shows you that the massive policy response is actually helping to cushion that, and it would be much worse otherwise. And then in the second half, you're going to start to have some recovery. And by 2021, you're going to have a rebound that in global GDP that should be around 5%, hopefully around 5%. But it's going to be gradual, and it's going to be uneven across countries and regions. And trade is a big part of this. I was talking about it before. Trade is expected to plummet in 2020, and it's not going to start recovering until trade in goods starts to pick up a bit in the second half of the year as lockdown measures are lifted. But even so, the numbers this year, we see a collapse in global imports ex-EU of over 10%, and then a recovery of just over 6% next year as activity returns. But trade flows are going to be weaker for a long time, and there are these big questions about what happens to global supply chains and how much businesses decide to change things there. And then there's also the risk of renewed protectionism, although, as I said at the outset, the forecast is assuming that we don't see a big increase in protectionist trade policies. So
and
let me
really
stop
quick,
there.
really quickly on the trade front, what's the state of trade negotiations between the EU and the UK? And has that been taken into consideration for your forecast? And also, how are the trade negotiations going with the US, EU-US?
Right. So the forecast assumptions are that trade tensions will not escalate, and that we will have a status quo in the EU-UK trading relationship. Having said that, trade negotiators really do have their plates full right now, because the EU and the UK still need to define their future relationship after the transition period's over. Talks have been ongoing during the pandemic by video conference, so they've not been disrupted, but there is a lot of work remaining. They have to sort out some major issues, including EU-UK regulatory alignment, how to maintain a level playing field in the single market, how to implement the customs union in Northern Ireland. So these have not yet been nailed down yet. During the transition period, which ends at the end of this year, the UK is still a member of the EU single market and customs union, and it's still covered by all the international trade agreements. So there's no disruptions this year, but next year that will change. And so the UK has been trying to open trade negotiations with the US and others. There have been some rumors out of the US that the US might try to pursue a mini deal with the UK, kind of like the phase 1 deal with China or Japan. We don't know, they might try to do that, but we do believe that, broadly speaking, most stakeholders in the US, including the business community and Congress and probably USTR, still prefer a comprehensive FTA that would include agreements on agriculture and financial services, and even some standards and regulatory cooperation. So these are tricky, and it's not clear if they're going to be able to do that in time, given the constraints put on by the pandemic and also by the upcoming US election. So we're not sure what will happen, but we think that it's going to take some time for the US and the UK to reach a comprehensive deal. And we're not sure that can happen before the long-term relationship between the EU and the UK has been sorted. So with that, let me stop and turn it over to Dimi.
Thank you, Ben, and good afternoon to all our participants. Welcome to my Zoom room, which also acts as kitchen and living room these days. Here, let me also express my sincere thanks to the EU delegation and the organizers for hosting me in this panel. In my intervention, I'll focus on financial market developments and on the measures taken by the ECB in the last months. And in doing so, I'll try to be as non-technical as I can. Beginning with European stock markets, on the left-hand side of the slide you're looking at, the start of the year found markets recording considerable valuation gains following a positive 2019. However, stocks experienced strong valuation declines across sectors at the time of the COVID outbreak, especially in March, when Europe came to be the epicenter of the pandemic, as both demand and supply side concerns weighed on market valuations. In particular, the equities of banks and insurance companies, which you can see in blue and gray, underperformed those of other sectors against the background of profitability and balance sheet health considerations. Another characteristic of this forceful correction episode in stock markets was that valuations had been exacerbated by alarming levels of volatility, close to those seen during the global financial crisis in 2008. Increased volatility was also visible in credit markets, both in the corporate and the sovereign bond spaces. As you can see on the right-hand side of the slide, yes, thank you. Conditions in the corporate bond market deteriorated sharply in early 2020 against the back of rising risks related to credit, liquidity, and significant investment fund outflows from this asset class in view of possible rating downgrades. The significant spread widening to levels last seen in summer 2012, especially in riskier investment grade and high yield segments, effectively led to a shutdown of primary market issuance in this asset class and drove many corporates to tap bank credit lines where available. Shortly after COVID was declared a pandemic, the underlying market dynamics manifested themselves in a similar fashion in the sovereign bond space. While German bonds absorbed flight to safety reactions in the form of strong yield declines, on your left-hand side, you should be able to see that risk aversion resulted in significant spread widening for other euro area sovereign bond issuers, and hence a tightening in financial conditions for the euro area as a whole. In other financial market developments, market-derived indicators of inflation expectations had fallen to all-time lows by early March, as can be seen on the right-hand side chart. While in part reflective of financial market movements and risk aversion flows, so some technical flows, these developments were also indicative of the uncertainty that characterized the inflation and growth outlooks at the time, both of which were subject to significant downside risks in light of considerably lower oil prices and weakening pressures on economic activity, which Ben referred to earlier. As such, they had direct implications for the ECB's pursuit of its primary objective, which is price stability. Given the size of the corona macroeconomic shock and the risks, maybe change slide, thank you. Given the size of the corona macroeconomic shock and the risks to the effectiveness of monetary policy from tighter financial conditions, the ECB's monetary policy response since mid-March followed a three-pronged approach. First, ensuring that the overall monetary policy stance is sufficiently accommodative. Second, safeguarding market stabilization and thus ensuring the smooth transmission of monetary policy to the economy. Third, making sure that ample central bank liquidity is available, especially in order to maintain credit provision. This is translated into a substantial package of very accommodative monetary policy measures and banking supervision measures, aiming to mitigate the impact of the coronavirus pandemic on the euro area economy and to support all European citizens. I'll make an effort to describe this policy package in simpler language below for our audience's convenience. Maybe I just start by saying that in its structure, the euro area is a bank-based system, also perhaps with a high SME ratio, and our measures very much reflect this feature. With the aim of supporting access of companies and households to credit through the introduction of additional LTROs, this is short for longer-term refinancing operations, PELTROs, pandemic emergency operations, and even more attractive TLTRO 3 terms, that's targeted LTROs. We have increased the amount of liquidity that banks can borrow from the ECB, provided they lend to the economy. While starting out at already low rates, we made it even cheaper to borrow from us so as to further incentivize lending activities. And we also made it easier for banks to borrow specifically to make loans available to those hit the hardest by the spread of the virus. Additionally, to facilitate bank borrowing, we eased our standards for the assets that banks give us as collateral when they borrow from us, and temporarily expanded the list of assets we accept in this context. Measures taken by the ECB supervisory arm, like temporarily relaxing bank capital and operational requirements, will further enable banks to dedicate resources to lending activities. In addition, the 750 billion euro pandemic emergency purchase program, or short PEP, aims to ensure easy financial conditions across the euro area so that citizens, households, firms, and governments can get access to funds they may need to weather the crisis. This program complements the asset purchase program, which we have had in place since 2014, for which an additional 120 billion euro envelope was also decided for the coming months, in addition to the monthly net purchase of 20 billion euro, which we recently started. In sum, in our package, we have over 1 trillion euro of additional net stimulus that we can deploy and use to purchase assets until end 2020, whereas our targeted lending facilities provide for around 3 trillion of liquidity to banks at a negative rate. Last but not least, the ECB has recently introduced or reactivated swap lines with central banks across the globe to address elevated foreign currency reserve demand. Thank you.
Dimitri, really quickly on that note,
sure.
The ruling of the German Constitutional Court, is that going to limit the capacity of the ECB to do whatever it takes to support the economy? And then also, if I may ask a second question related to that, will that constrain the ECB monetary policy to expand the asset purchase program going forward?
Thank you, Yvonne. Indeed, a topical question in press rounds these days. So on the ruling itself, the ruling that you referred to, as you might be aware, the ECB recently took note of the relevant judgment by the German Federal Constitutional Court regarding the Public Sector Purchase Program, or PSPP, in the public communication. Let me also clarify here perhaps that the PSPP is a program that has been in place since 2015. The ruling does not refer to the more recent and pandemic-specific PEPP or PEP. What is important for our audience to keep in mind here, and which also serves as a basis for an answer to your question, Yvonne, is that, as President Lagarde recently said, we remain undeterred in delivering on our price stability objective. And this includes doing everything necessary within our mandate. I would also believe it's useful to recall in this context that the ECB, as a European institution, is under the jurisdiction of the European Court of Justice, which ruled in December 2018 that the ECB is acting within its price stability mandate on the PSPP. I hope this helps answer your question.
in this context, if I may have a quick follow-up, would the EU be better served with more fiscal unity? President Macron recently stated that the EU will unravel without it.
Fiscal unity can be a good complement in an effort towards deeper European integration that started years ago with the establishment of the ESM, with the SSM, so elements of the banking union, with the agenda on the capital markets union and so on. And in that, it has the capacity to provide for a liquid euro-based market, asset market, but also to give an additional layer of, let's say, an additional layer of protection to the area from shocks, and in terms of joint policy response. But it would be probably difficult for me to comment on a matter that is probably to be commented on and decided upon by the political world. So I would probably leave it at that.
Thank you.
Okay, so I will take on from here. Thank you, Dimi. I'm going to go a bit in reverse order, maybe, and start from the graph on the right-hand side. And this is just to show that this is overall a deflationary shock we're talking about. Ben mentioned a bit the different demand and supply shocks before, and that are playing out throughout this pandemic. But the net effect is going to be deflationary on the prices dynamics. And we have, both components, what we call the core inflation, that is sort of the more stable part of inflation that reacts to the amount of slack that there is in the economy, and that is the gray part here. But also, the very strong shock that comes from the more volatile components like energy and unprocessed food. So that's the oil part. So these two combine, and you see that actually inflation, or we're going to have a period of deflation, negative price dynamics in the second half of the year. Then as we go forward, the negative shock of oil is set to be reabsorbed, and the slack will start to also be reabsorbed. Slack on the decrease in activity picks up, and core inflation starts resuming the positive trend it had before the coronavirus. So what does it mean? This means that, with all the measures that Dimi was referring to, we're going to have monetary conditions that are going to remain extremely accommodative throughout the forecast horizon. And that is shown here with the rates, both the long-term rates and the short-term rates, these are the nominal rates. And maybe just a bit to explain this weird dynamic that we have here with the real rate, that is sort of the nominal rate corrected for inflation, is that basically as we are pushed a bit into deflation, into the second part of the year, the real rates first increase, but then they resume decreasing. And this unprecedented monetary stimulus that is really, in the ECB, in the EU, Euro area, but also across the EU, but it's really been global. If you look at what the Fed is doing, what the Bank of Japan is doing, has been also accompanied by a very strong fiscal response. This fiscal response, of course, has been massive in the US, and you have seen, this accumulation of phase 1, phase 2, phase 3 packages that have been passed by Congress. And just recently, the CBO, the Congressional Budget Office, has projected the impact that this is going to have on the overall federal deficit, which we might see, go beyond almost 20% of GDP this year. Other advanced economies like Japan, which you see in light blue here on the graph, have done a bit less in terms of fiscal stimulus. And when it comes to the EU, it's a bit in between these two extremes. And that is in the red thing. What we said is that we started from a relatively sound fiscal position in the aggregate, with the deficit of just about 0.5% of GDP. And we're going to see this expand to over 8% of GDP this year before contracting again in the course of 2021. And what is really driving this expansion is what we call automatic stabilizer. So that is sort of the cyclical component of the deficit or the budget. So the share of safety net, of expenditure dedicated to social to safety net and welfare system is relatively much larger, of course, in EU member states than it is in the US, and that makes that EU budgets tend to, because as labor income, as households lose labor income or income from other sources, they become more or less automatically eligible to other forms of social transfers, and that means that the public deficits automatically tend to expand, and then as economic situation improves, the deficits tend to shrink. So you don't have to go through all this ad hoc fiscal stimulus, as is a bit in the case in the US. But on top of this darker blue sort of cyclical component or automatic stabilizer, there has been also significant measures taken in terms of discretionary spending that includes first and foremost expenditure on public health, emergency public health, but also, as we shall see later, public investment.
Chris, just to make sure that I understood this right, so that what you just explained is the reason why the fiscal stimulus in the US looks so much larger than in Europe. But what you're saying is that the automatic stabilizers that Europe had made up for the difference.
Well, yes. I mean, I would first three things. I mean, one should really look at the change in the deficit. So number one, of course, the deficit of the US looks very large, is going to look very large this year, but it was already starting from a relatively high position because of the tax reform and other measures that were put in place before. So you have about 11 percentage points of GDP increase in the deficit. For the EU, it is less. I would say that it's also probably because of this existing system, it's slightly more targeted, the support that we are able to deliver. But it was also, to a large extent, also delivered in a more automatic way through systems and social safety nets that were really existent before, and in some cases were extended and tweaked to cater for the specificities of this crisis. But I would also, maybe, and this allows me for a smooth transition to the next slide, mention the fact that one should really look at the whole package of the response put in place by fiscal authorities. So you have measures that are, deficit increasing, but on top of that, there has been a large share of measures that are just providing liquidity to the private sector, liquidity enhancing provisions. And that includes, to some extent, measures like tax deferrals or social security contribution deferrals. I mean, these are the debt, these are just deferrals of debt that the private sector has with the state. So they are not increasing the deficit, but help them in their liquidity. But the bulk of it has really been the guarantees that the EU member states have put in place for loans to the private sector. And they have put in place these guarantees through their network of mostly through the network of national promotional banks. And I've listed some here on the right-hand side, the KfW, the Caisse de Dépôt Group, Cassa Depositi e Prestiti, and all these promotional banks really work with the private banking system, and they extend then in turn their guarantees to the commercial banking system. And I mean, this is good in a way because it gets the money out quickly, but it's also good because banks really have a skin in the game when they are extending these loans to the private sector. And we are really now in a situation where it's very difficult to distinguish what is a solvent business which might go through a liquidity problem and what is an unsolvent business. And the overarching philosophy behind this approach is that the banks are probably the best one to call the shots, but also they have an interest in making sure they pick right which are the most deserving businesses in this sense. And then the measures by the member states have been complemented by a number of measures at EU level with the European Union budget, and that includes the support to mitigate unemployment risks. The ESM, there is a credit line that member state can draw from up to 2% of GDP. And then the promotional bank of the EU, which is the European Investment Bank, which has put in place its own for guarantees. So when you put this all together, you arrive to about more than 25% of GDP in terms of guarantees and liquidity measures that have been put in place, which is much larger than what has been put in place by other jurisdictions, Japan or US listed there. And here I just would like to move to the labor market, because we have talked a bit about these schemes and the wage subsidies and short working time arrangements, measures that have been able to shelter the workers from the sudden increase in unemployment. And what we're seeing here is that, first of all, what was the bright spot of the EU economy during the past years was really sort of the progressive reduction of the high unemployment rates that came as a result of the great financial crisis and the debt sovereign crisis. And we also had seen sort of a reduction in the dispersion of unemployment rates across the EU. But that trend is going to be reversed this year. That's without a doubt. But the 2019 closed with an unemployment rate of 7.5% in the EU, and it's set to be, euro area, slightly less in the EU. It's set to be increased to 9.6%. This is 5 million more, roughly, workers that are going to be unemployed. So it's not a negligible number, but definitely as compared to some of the numbers that are coming from the US, it looks like a relatively modest increase. And that is really because of the working of schemes such as the Kurzarbeit, which has attracted so much attention in Europe, in the US, but similar schemes really existed already throughout Europe, and especially in continental Europe. And sort of the basic or overarching principle of all of them is that they allow for a wage subsidy or a partial unemployment benefit without the employment contract being terminated. So workers remain linked to their enterprise. And this is particularly good, of course, at the moment of reopening, because firms do not have to go through that costly and traumatizing firing and hiring, but it also helps the workers because they feel that they remain more attached to the labor market. It helps consumer psychology. Maybe just a word of a caveat here is that these schemes, which I think rightly so have attracted a lot of attention also in the US, have nevertheless some gaps. I mean, they tend to work much better if you have a lot of very large companies. They work better in manufacturing than in services. And they work better in sort of what we call the primary segment of the labor market. So the EU as a whole has, the best way to describe it is are part of the labor market that looks more like Japan, where you have a very high employment protection, very long careers with the same employers. And then there is another part of the labor market that is much more flexible, that it's a bit more US style if you want. And this part, it's made of temporary employment, temporary contracts, or a lot of different forms of self-employed categories, and they tend to be much less covered or well covered by these measures. So there is nevertheless going to be an increase in unemployment, and there will be some countries in particular, you look here, Spain with its high share of temporary employment, or Italy with its high share of self-employed, which will have more trouble in sheltering their workforce. Having said that, ad hoc measures have been put in place also in these countries to fill some of the gaps.
Yeah, Chris, we have 10 minutes left and we have a number of questions from the audience. But just really, really briefly, can you compare this real quick to the Paycheck Protection Program? I think we need to also wrap it up because we have a number of questions coming.
Sure, we'll do so. I think, all in all, that the PPP was the flagship of the CARES Act, and now it has been also replenished. I mean, there is some evidence that maybe the targeting was not as great, or there has been some weakness in rolling it out. I will not, but other people are better, I think, to make that assessment. What I would say is that the PPP was really trying to do two things at the same time: providing that liquidity to firms, but also sheltering the employees, and that with one instrument. And the way it did it was actually with introducing quite a lot of parameters about what can be done and what cannot be done with the money. And this is maybe some flexibility, taking away some of the flexibility that employees really need at this stage. Let me quickly wrap up my part of the presentation so that we can move to the Q&A. We have here a measure of the consumer confidence, which is basically the difference between how they see the current situation or the past situation, or how they see the future 12 months ahead. And we see that that has really plummeted as a result of the shock. So we have this big shock on the consumer confidence. We have the social transfers, which are all these mechanisms that I was referring to before, are basically turning from what they usually are, a drag on the household's budget. They are now turning positive. They are supporting the households, and they're almost completely offsetting the decrease in wages, the decrease in employment, and the decrease in other earnings. So overall, we're looking at a relatively contained drop in real disposable income for households. Nevertheless, we have that consumption is going to be affected, and that is because we have this shock that Ben also was referring to on the confidence, and this surge in savings. Our assumption is that a lot of this surge in savings is also dictated or driven by the constraint measure, by the lockdown, and that will progressively be absorbed as we go further. Investment also is going to be a major hit. Of course, this is the most volatile component of demand, and the fact that profits are going to be negative profits, a lot of losses, a lot of inventory built up are going to be a drag. One positive is maybe going to be the deployment of some public investment. And of course, the mirror image of what Ben was referring to before, the contraction in global demand is going to affect the exports of the euro area. So when you wrap it all together, we are going to have this massive decrease of activity this year and the rebound this year. And you have seen it maybe throughout the graphs that I was showing before. You have this dynamics which looks a bit like a V, where you go down sharply and down up again. It's not quite a V, and I think the best way to think about it is sort of more of a swoosh shaped recovery, as you see here on the right hand side, because you go down very sharply, and this is not rates, these are level. But then you progressively come up. And in fact, according to our forecast, that by the end of 2021, the EU as a whole will not have recovered the level of GDP that it had, the level of income it had before the offset of the crisis. And what is even more concerning is the fact that there is going to be some dispersion in the pace of this recovery. And there's going to be a lot of debt, of course, that is coming out of this, a debt overhang, less so in the euro area and in the EU than what is going to be in the US. But of course, the particular issue that the EU is dealing with is the level of dispersion, the fact that this debt is unevenly distributed across member states. There are a number of risks to the outlook. High level of uncertainty referred to Ben before. I will not go through them. You have maybe just one is really something that concerns the European Commission, the European Union very much, is the fact that this is turning out to be an uneven shock, that the capacity of member states to respond is uneven, and the risk is that this will be an uneven recovery within the EU. And this is something that really the EU is determined not to let happen. And so maybe moving to the positive, besides the obvious of the vaccine availability faster than expected, one positive maybe shock that we could have or risk is really having a much more forceful and much more ambitious EU response to this crisis. And this is something that seems to be shaping up, and that we are actually having some positive rumors coming out from Brussels and from the European capitals these weeks. But the European Commission will come up with its blueprint on the 27th of May. So you have to be patient just a little bit more to see what will be in there. I think some elements are more clearer. Some elements are still a bit uncertain, including how much the size of the fund will be in the end. So these are details that will need to be cleared up. And I leave it maybe with the slides. I will not go through it, but here are the key messages, the key takeaway from this forecast.
Could you? We're going to go a little bit over, but could you just say a few words about the Franco-German initiative for a recovery fund? Because that's addressing exactly the the potential for an uneven recovery across Europe, and how that plays out with what the Commission is working on.
So that was a big surprise to some extent. I mean, and you might have heard about this press release, the press conference that Merkel and Macron gave, and they highlighted the elements of an endorsement or an agreement of a European recovery fund, which has many elements that seem to be in line with the proposal of the Commission. In particular, the fact that this will be funded through European Union debt, so additional debt taken by the Union, if you want a sort of federal debt, that it will be implemented through the EU budget, which means several things. First of all, that it's using existing mechanism, but it's also it's going to be easier to direct it to certain priorities, because all the money will be related to programs and projects of the EU. Ultimately, not an irrelevant factor, it is subject to the European Union Court of Auditors oversight, which is also, of course, an element that might induce some elements of confidence. It is, again, mostly directed to investment, and it would seem that, because it's implemented fully, entirely through the EU budget, it's actually all grants, so it's not loans to member states. This is grants. It will be paid, of course, back by member states, but in the forms of future contributions to the EU budget, and this can take very long maturities. Muted.
We have a quick poll that we're going to bring live, and then we're going to go on to Q&A. And I would like to start the Q&A by asking our first question to Alison Sirkin. He's the Program Officer for Europe and Eurasia at the Business Council for International Understanding. Alison, do you want to ask your question?
Alison seems to be muted.
Hi.
Oh, there she is.
Okay, wonderful, wonderful. Thank you all on behalf of BCIU for your coordination in organizing this. Ben touched on his thoughts on the global supply chain within the EU, but I'd be interested in the panelists' thoughts and insights on how this might impact or propel initiatives set out in the Circular Economy Action Plan and European Green Deal.
So maybe I'll start. I mean, I think there are definitely some elements, especially as they are shaping up, including what I was referring to, the fact that the recovery fund will be delivered through the EU budget, that make it that it's going to be more likely or easier in a way to make sure that the recovery plan is really aligned with the priorities of the EU, especially as set out in the Green Deal. I think there were also elements in the press release of the German and German-French agreement that highlighted the fact that investment should be directed to the green and to the digital transition. So I think all in all, this fits very nicely with what Ursula von der Leyen said in one of her speech recently, is that the Green Deal is going to be the motor of our recovery. The two are actually linked very much together. And maybe I'll just turn it over to Ben to say something about the supply chains.
Yeah, I think that one point I'd like to make about the Green New Deal is that that I think it's some questions in the United States, is that the Green Deal in Europe is very much meant to be a source of job creation. There's not the idea that this is going to cost so much money to transition to a lower carbon economy, and therefore that maybe policymakers should be reluctant to do it. Rather, the idea is that Europe has made clear commitments to reduce carbon emissions and to confront carbon change, and they are going to be at the forefront of the new technologies that are going to take over. So
electric vehicles and more efficient electricity generating systems all over the place. So I think that there's a lot of stuff both in the green and tech sector that is going to be a positive for jobs, and especially when you're talking about a recovery mechanism, a recovery device. This is something that very much fits into what people are asking for, given the need for people who have lost jobs in certain most affected sectors. So that's one point. The second point is that, in terms of this forecast, there is some minimal assumptions that there will be some slight bit of re-onshoring after this, but the forecast still thinks that for the most part, trade is not going to be hit by a huge new wave of protectionist measures. There's not going to be big, huge disruptions to supply chains. Now that is an uncertainty. We're not really sure, and it's certainly a downside risk if there was to be the reemergence of trade wars. But for the most part, I think that Europe wants to build up its industrial capacity in a lot of these emerging technologies and green technologies, and it's aiming to do so with a positive idea of being able to reduce carbon emissions and create new jobs, and not in a protectionist manner.
That concludes today's webinar entitled Europe and the Great Lockdown, Economic Recovery, Economic Outlook, and Policy Priorities to Reopen the EU Economy. This event was organized by the European American Chamber of Commerce and our network of chapters across the United States and Europe. We are where Europeans and Americans connect to do business. Thanks to the European Union for funding this event, and to the support of the Business Council of International Understanding and the State International Development Organization. Thanks also to our presenters, Christian Orsini, Ben Karliner, and Dimitrios Ratzikis for sharing your experience and insight. Thanks also to Yvonne Bendinger-Rothschild for moderating the discussion. And most importantly, thanks to you for joining in today's event. As a reminder, all comments and opinions presented by our speakers today are their own and do not necessarily represent the views of the European American Chamber of Commerce or its members. Please stay in touch with your local chapter of the European American Chamber of Commerce for information on upcoming webinars and events. And also be sure to look for a recording of this and other EACC webinars and events on our YouTube channel. Farewell.